It's time for the Phil Ferguson Show.
This is Phil Ferguson, and you are listening to the Phil Ferguson Show. Again, my apologies for being late, I guess. I'm supposed to do this once a week. I think that's how the world works, but I find that I often cannot. 8 to 10 days, sometimes 14 days seems more likely. So my apologies. If you really want the show every week, I try, but damn, sometimes shit comes up. But the fun stuff that we're going to have in the show today, I'm going to do a little segment on ETFs. Often I get people asking me why I use mutual funds or index funds instead of ETFs. You know what? You're just going to have to wait for that segment. But I think it'll answer a lot of it. You still may not agree with me, and that's okay. But from Vanguard's perspective, they have clearly said on multiple occasions that buying or selling ETFs versus their index funds, you're essentially doing the same thing. There's not a meaningful difference. Another segment, a couple of scammy things, some emails that I have gotten. Well, actually, in this case, it's an email was one of them, and the other one was something that came in the mail. So just kind of things to look for, things to think about, and hopefully by listening to the show and or other shows or reading the books that I recommend, you get a better foundation for how investing works. And if nothing else, if it prevents you from doing one really stupid, fucked up thing, boy, it could be worth all the time and effort that you put into it. And then really late in the show, just a quick thing that I recorded just this morning on the value of diversification, the value of having the cushion in case the markets go down, and why the terms that I have of granularity and clarity are so important. And why that is so meaningful. And this is why, as an example, in context of that segment near the end of the show, you'll hear it. If you just had a target date fund, you can't do the things that I'm going to talk about in that segment. You might have had the same basic result as far as market performance, but if you need to rebalance or take money out or add money, you can't do the things that you can do if you have a portfolio of a variety of index funds. So I'm going to talk about the value of that diversification, a little bit how it works, a little bit how you can manipulate it, and because of the granularity and the clarity that you can see what you own as far as different market segments and asset classes, what you can do if you need to take money out, things that you can't do in a target date fund. Now, warning, I am not saying target date funds are evil and you should never have them. In some cases, it may be the best option available to you. So just keep that in mind. I'm talking about very specific things. I'll go over more of that in that segment. But before I go on with that, I got to talk about this Ukraine thing. Oh my, I'm so mad. I'm so upset. I'm so frustrated. I don't know anyone from Ukraine, but it's wrong. And what is happening and what Russia is doing is wrong. And yes, I do blame a lot of this on Trump and Republicans that made really material efforts over the last many years to cut Ukraine out, to make Ukraine look like the bad guy, to make Ukraine the enemy of Republicans, to officially put them in the campaign platform to not support their acceptance into NATO. And Trump, of course, talking continuously about how NATO's a scam and they're taking money from us and they're not paying. If they want protection, they have to pay for it like everybody else. And of course, Trump's love of Putin. And I've even heard some conservative friends, maybe soon former friends, Trump lovers who say, well, this didn't happen when Trump was in office. No, it didn't happen, but the groundwork was laid while Trump was in office. Recently, Trump went on and got interviewed, and here I'm going to have some of his things here. This is from the Washington Post, but most of it's going to be talking about what Trump specifically said, where apparently Trump did call Putin genius, and I think Trump has Putin envy because he wishes he could do this. So here is mostly the quote. I'll try to keep it clear. Quote from Trump. Putin declares a big portion of Ukraine. Putin declares it as independent. Oh, that's wonderful. I say, how smart is that? And he's going to go in and be a peacekeeper. We could use that on our southern border. That's the strongest peace force I've ever seen. There were more army tanks than I've ever seen. They're going to keep peace all right. No, but think of it. Here's a guy who's very savvy. What? Trump goes on, just to make sure that you're clear. Quote, he liked me, I liked him. And of course, then he goes on to praise him. He's a man with a lot of charm and a lot of pride, and he loves his country. So that is another expression of Trump and his subservience to Putin, how he loves Putin, how he loves power-hungry dictators, and he desperately wants to be one. And at this point, if you still support Trump, fuck off. I can't believe that we're having this conversation. I can't believe that there is a consideration that Trump still controls the Republican Party, that Trump may run again, and that, who knows, 30%, 35% of America, 40%, which might be enough, of the country would actually vote for him to be president again, knowing that this is what he thinks of a dictator, of the actions of Russia unilaterally attacking openly a European country. I'm beside myself with anger and frustration that we are in this place. So, rant over. Let's take a quick break for something fun, and we'll go on with the rest of the show.
Section 9. Is Christ our example? He never said a word in favor of education. He never even hinted at the existence of any science. He never uttered a word in favor of industry, economy, or of any effort to better our condition in this world. He was the enemy of the successful, of the wealthy. Dives was sent to hell, not because he was bad, but because he was rich. Lazarus went to heaven, not because he was good, but because he was poor. Christ cared nothing for painting, for sculpture, for music, nothing for any art. He said nothing about the duties of nation to nation, of king to subject, nothing about the rights of man, nothing about intellectual liberty or the freedom of speech. He said nothing about the sacredness of home, not one word for the fireside, not a word in favor of marriage, in honor of maternity. He never married. He wandered homeless from place to place with a few disciples. None of them seemed to have been engaged in any useful business, and they seemed to have lived on alms. All human ties were held in contempt. This world was sacrificed for the next. All human effort was discouraged. God would support and protect. At last, in the dusk of death, Christ, finding that he was mistaken, cried out, my God, why hast thou forsaken me?" We have found that man must depend on himself. He must clear the land. He must build the home. He must plow and plant. He must invent. He must work with hand and brain. He must overcome the difficulties and obstructions. He must conquer and enslave the forces of nature to the end that they may do the work of the world.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions.
You're listening to The Phil Ferguson Show.
This Investing Skeptically segment is on pricing of ETFs, and I guess specifically the price that you get when you sell it and the price you might pay when you buy it. This had to do with potential new fees for mutual fund transactions at TD Ameritrade and or Schwab going up to buy Vanguard funds. And I had mentioned that one possible way to reduce the transaction fee is to get an ETF, but then I mentioned that you might not always pay or get what it's actually worth. And actually is even a fuzzy word there. And I got quite a few emails about that. And the questions were a little different from each author, but I'm going to kind of sum it up here. And I found, I think, a beautiful explanation of this. I found this at a Vanguard website. It's called advisors.vanguard.com. And they often do a lot of stuff to explain things to investors. And I just happened to find this on my Google search. The title of it is Shining a Light on Opening Auctions When Trading ETFs. And it is dated September 15th, 2021. In case you want to go look at it, it does have a couple of nice tables to try to help illustrate the process. But there's a few things that I think I want to go over before I get into the trading and buying and selling part. A mutual fund and an ETF have a thing that's called net asset value. And that basically is the most precise, accurate estimation. It's pretty darn accurate of what a share of that ETF or a share of that mutual fund are worth. With a conventional mutual fund that you might be thinking of, or an index fund, which is a subset of a type of an open-ended mutual fund, the net asset value is calculated once a day. And they basically calculate that by saying, here's all the stuff that we own. We own this many shares of company A, this many shares of company B, et cetera, et cetera, et cetera. And these are the closing prices, the last trades at the end of the day. And the computers, very high-powered computers, of course, figure out the price of each and every stock owned in that fund, and they multiply it by the number of shares in that fund, and then they add it all together and divide by the number of shares of the mutual fund that you could send money in and buy, and they create the net asset value. Now, that number is very precise. It's exact based on the data that's given to it. If all of the companies that mutual fund owns are overvalued, according to you, according to me, according to the market, by 20%, at least they're overvalued by 20% tomorrow, then the net asset value would change if they're no longer overvalued. So the calculation is very precise. Of course, you can always argue that the market or large sections of the market are over or undervalued, but that has nothing to do with the specific calculation of that mutual fund. So when you add money to a mutual fund, and let's say you do it at 2 in the afternoon, that's cool. That transaction goes in and it just kind of hangs out and waits until the market closes, until the mutual fund that you want to put money into calculates its net asset value. And at the end of the day, that's the price you're going to get when you get new shares of that mutual fund. Some people don't like that. I get it. I like it. I'm okay with it. And one of the reasons I like mutual funds over ETFs is that it's really hard for you to get kind of into day trading because you have to wait. So if you see that the market's down 3% at 1 in the afternoon and you think, oh, it's a 3% dip, I want to buy. Well, you can't buy at that moment. You can put in your order and your order is completed at the close. If the market's still down 3%, okay, you might buy shares in that mutual fund at a discount compared to what it was the day before. But if the price bounces back up to where it was at the beginning of the day, at the end of the day, you missed that little dip opportunity. I don't want to play that game, so it doesn't bother me. If it really bothers you and you want that opportunity to game the system or to day trade, then mutual funds is probably not a good choice for you, or at least not all of your investments. But I'm good with that. I don't want you day trading. I want you regularly, constantly investing systematically on a regular basis. I was just popped into my head, side channel. Every once in a while, apparently, I say systemically when I'm supposed to say systematically. So I'm working on that. Anyway, so that's a mutual fund. You pay the price that is calculated. It's the net asset value price. With an ETF, an exchange traded fund, one of the reasons I don't like them is because you can trade them during the day. There's also a process in place where the net asset value of an ETF is calculated on an ongoing process, continuously during the day when things are traded. So you might be able to jump in and buy shares on a dip. If the price of that ETF goes up by $1 or $2 on a net asset value, you might be able to go and sell it at a premium. However, ETFs don't sell for the net asset value price. It is calculated and it's probably available and pretty close to real time, but that's not the price you pay and that's not the price you get. Shares of an ETF trade like shares of a stock. Now, with the stock, calculating its individual value is an art, a science. You could study it for 10 years and still not know everything about it. And it's one of the reasons I don't buy stocks, because calculating the value of a company is profoundly complicated. And there are different opinions on what is the right way to do it. But you can probably get into the ballpark. But the ETF will use the actual trading prices as the quote unquote real price. And they'll kind of calculate like the mutual fund does, but in real time. So you can go buy and sell in real time. And you might think, I will follow the net asset price, the net asset value price, and I can buy and sell in real time. Well, that's not the price you pay. That's not the price you get. It's kind of like with the company stock. You may have come up with a calculation to figure out what the company is worth per share. And you go out and you want to buy it. But if nobody wants to sell you at the price that you think it's worth, you are not going to buy it. You're not going to be able to buy it. You have to pay more because people want more money. Same kind of thing with an ETF. And it's one of the problems with ETF investing. I said that right? ETF investing. You may have to pay more than you think you should. You may get less than you think you should when you sell it. And this specific article brings up yet another potential problem, and they recommend against this specific action. And I'm also going to recommend against it. If you own a mutual fund, you can put in the order to buy or to sell more dollars in value or more shares at any time, and they all happen at the end of the close of business. If you put it in too late on Friday, it's not going to happen on Friday. It's not going to happen on Saturday or Sunday. And if Monday's a holiday, it's not going to happen. It might happen on Tuesday evening. And that's just the way the system works. With an ETF, if you put the order in late on Friday and the market's still open, poof, it can be transacted. But it's not going to be transacted at the net asset value price. It will be based on market transaction activity, buys and sells, supply and demand. So if there is a calculation that says the ETF that you want to buy is worth a net asset value of $100 per share, and that happens to be the ETF that you want to buy, if no one is offering shares to the marketplace at $100, you will not be able to buy it at $100 because no one is selling it. Just like a stock. If you think the stock is worth $120 and its current price is $100, you can put in an order to buy the shares at $100. But if there are none for sale, you may get none. Now, there's things called market makers that might facilitate the transaction just to keep the markets moving. And the same thing can happen with ETFs. But likely what you're going to have to do is increase your price. Or, if you have that your trade is open for an hour or at the end of the day, it may not happen. So you might have to pay more. And that's one of the problems with an ETF is that if you have a very niche ETF, like say, for example, you have an ETF on the Russian stock market or stocks that are owned, stocks that are Russian company stocks. and something bad happens in Russia, and you're like, oh my God, that fund just went down 10% in the last 2 or 3 days. I want to get out. The problem may be that you are not the only person that now wants to get out. And so it was worth $100 and now it's worth $90 net asset value. But if nobody's buying that fund and many people want to sell, you might not be able to sell. You might say, okay, I want my $100 back. You can't have it. It's now trading for $90. It's trading for $90, but no one's selling, so it's not even trading. So you say, okay, I'll just take $88, or I'll take $87, or I'll take $85 or $82. And eventually there's somebody out there who might have an order that says, okay, if someone's desperate enough to sell this to me at $75 a share, I'll buy it. So if you have an ETF that's not broadly traded, you want an ETF that is very big, has a lot of money, has a lot of potential people buying and selling it. One of the most famous one is SPDRs or QQQs. The SPDR is for the S&P 500 and the triple Qs are for the NASDAQ index. Millions, trillions probably of dollars going in and out. And you can sell really close to net asset value almost any time the markets are open. But if you have something small and niche like a Russian fund, you have to find someone that wants to buy the shares from you. If something bad happens and it goes down in value, there is a possibility that not only did you lose money because your net asset value per share fell, but you lost even more money because no one wants to buy it, or at least no one wants to buy it at the price you want to sell it. So if you just put in a market order, the price you get will just drop to the first purchase price that's available to you. And so that can be pretty upsetting if you don't know how that works. All right, so hopefully that made sense. The other potential problem that kind of becomes, because of the way the system works for ETFs, I guess, and that's what this article is specifically about. If you put in an order to sell shares of an ETF after the markets are closed at 8 o'clock at night over the weekend, maybe you're used to doing this because of mutual funds. You can put in an order and you're going to get the net asset value price. Whether you like the price or not, that's what you're going to get. That's what you're going to pay. That's what you're going to get if you're selling. But with an ETF, that may not be how it works. And this article explains when there's what they call an orderly opening. Again, we're talking about an ETF with $99 or $100 a share of net asset value. And in the example in this article, if people want to sell 24,000 shares when the market opens, and other people want to buy 24,000 shares when the market opens, they'll all transact at the net asset value price. Easy peasy, not a problem. It works out pretty well. But if you want to buy, or the inverse, of course, is true, is sell, and you put an order in before the market opens, let's say you want to buy. You want to buy shares of this thing for $100. When the market opens, if there's no one selling at a market order, or very few sellers at a market price, you're not going to get the net asset value price. The exchange will have to look at who's selling or who's offering to sell and what prices they're offering to sell. And so in this example, there's some that are willing to sell for 105 cents, 150 cents, up to $102.50. And so to execute all of the purchases, all of the buys, they have to match up all of these sells, which have limit orders, how little they'll take. And what you thought you were paying was going to be a $100 the net asset value, you may actually pay $102.50, just because that's what the opening trade starts at, because of supply and demand and because of the orders that are in place to buy and the orders that are in place to sell. And the market balances that out automatically for you. If you were to buy 50,000 shares of something and you paid $2.50 more than you expected per share, it's not rocket science to figure out 50,000 shares times $2.50 is going to be $125,000 that you lost because you overpaid for something. So make sure you understand how that stuff works, because this is an example of, instead of paying the $50 to $75 transaction fee to buy the mutual fund, you might get a $10 or a $15 or a $0 ETF trade that cost you $100,000. I mean, this is obviously a big order. So let's say you bought 1,000 shares and they're at $100 a piece. That's a $100,000 order. So this is just one ETF in your portfolio. But if the price variance is off by $2.50 against you, it could also be in your favor. But if it's against you and you buy 1,000 shares at $100,000, you could lose $2,500. So keep that in mind. Understand what you're doing. Know what you're doing. This is, of course, another reason for me to not like ETFs. I did mention also there is the possibility that the broker that you're going through to sell your ETF, while they only charge you $10, they might have a little bit of a thing called a spread. And you're trying to buy at $100 and someone else is selling at $100.50. They match those orders up and they might make a little bit of margin. Margarine? No, not margarine. Definitely not margin. They make a little bit on the difference. There we go. And it might be pennies, but that's a big part of how a broker makes money. They capture that little bit of pricing inequity between. And so if it's not $2.50, it's only maybe say a quarter. Obviously, if you're buying 1,000 shares and there's an extra quarter you have to pay per share to cover the spread, it's not a lot of money, but it, again, might go towards defeating the process, the goal that you have to be cost efficient. Everything costs money, and you have to pay that. One of the things I like to do is when I'm paying something, I want to know that I'm paying something. But anyway, I've rambled on for much longer than I expected on this kind of complicated and nuanced situation. But that's some stuff about ETFs and the possible costs and the possible problems with buying and or selling during the day, during market open, during market close, and spreads. And if you understand that stuff and that's what you want to do, that's cool. But a lot of people that I talk to want to use mutual funds in part because they don't understand all this stuff and they don't want to go learn it. They have other shit to do. Anyway, a little bit about ETFs and the prices you might pay or get when completing a transaction.
Section 10. Why should we place Christ at the top and summit of the human race? Was he kinder, more forgiving, more self-sacrificing than Buddha? Was he wiser? Did he meet death with more perfect calmness than Socrates? Was he more patient, more charitable than Epictetus? Was he a greater philosopher, a deeper thinker than Epicurus? In what respect was he superior of Zoroaster? Was he gentler than Lao Tzu, more universal than Confucius? Were his ideas of human rights and duty superior to those of Zeno? Did he express grander truths than Cicero? Was his mind subtler than Spinoza's? Was his brain equal to Kepler's or Newton's? Was he grander in death, a sublimer martyr than Bruno? Was he in intelligence, in the force and beauty of expression, in breadth and scope of thought, in wealth of illustration, in aptness of comparison, in knowledge of the human brain and heart, of all the passions, hopes, and fears, the equal of Shakespeare, the greatest of the human race? If Christ was in fact God, he knew all the future. Before him, like a panorama, moved the history yet to be. He knew how his words would be interpreted. He knew what crimes, what horrors, what infamies would be committed in his name. He knew that the hungry flames of persecution would climb around the limbs of countless martyrs. He knew that thousands and thousands of brave men and women would languish in dungeons and darkness filled with pain. He knew that his church would invent and use instruments of torture, that his followers would appeal to whip and faggot, to chain and rack. He saw the horizon of the future lurid with the flames of the auto da fe. He knew what creeds would spring like poisonous fungi from every text. He saw the ignorant sects waging war against each other. He saw thousands of men under the orders of priests building prisons for their fellow men. He saw thousands of scaffolds dripping with the best and bravest blood. He saw his followers using the instruments of pain. He heard the groans, saw the faces white with agony. He heard the shrieks and sobs and cries of all the moaning, martyred multitudes. He knew that commentaries would be written on his words with swords to be read by the light of faggots. He knew that the Inquisition would be born of the teachings attributed to him. He saw the interpolations and falsehoods that hypocrisy would write and tell. He saw all wars that would be waged, and he knew that above these fields of death, these dungeons, these rackings, these burnings, these executions, for 1,000 years would float the dripping banner of the cross. He knew that hypocrisy would be robed and crowned, that cruelty and credulity would rule the world, knew that liberty would perish from the earth, knew that popes and kings in his name would enslave the souls and bodies of men, knew that they would persecute and destroy the discoverers, thinkers, and inventors, knew that his church would extinguish reason's holy light and leave the world without a star. He saw his disciples extinguishing the eyes of men, flaying them alive, cutting out their tongues, searching for all the nerves of pain. He knew that in his name his followers would trade in human flesh, that cradles would be robbed, and women's breasts unbabed for gold. And yet he died with voiceless lips. Why did he fail to speak? Why did he not tell his disciples, and through them the world, "You shall not burn, imprison, and torture in my name. You shall not persecute your fellow men"? Why did he not plainly say, "I am the Son of God," or "I am God"? Why did he not explain the Trinity? Why did he not tell the mode of baptism that was pleasing to him? Why did he not write a creed? Why did he not break the chains of slaves? Why did he not say that the Old Testament was or was not the inspired Word of God? Why did he not write the New Testament himself? Why did he leave his words to ignorance, hypocrisy, and chance? Why did he not say something positive, definite, and satisfactory about another world? Why did he not turn the tear-stained hope of heaven into the glad knowledge of another life? Why did he not tell us something of the rights of man, of the liberty of hand and brain? Why did he go dumbly to his death, leaving the world to misery and to doubt? I will tell you why. He was a man and did not know.
The Phil Ferguson Show is for educational and entertainment purposes only. Nothing said on the show should be interpreted as personalized investment advice. Investments should be based on your personal situation, and you, of course, should consult with your financial advisor or tax professional before taking any actions. I've got a little bonus segment for you that I'm going to call Random Scammy Shit. Just it's amazing the things that are out there, the things that I get, things that other people probably get, at least some of them. Two different types here. One came in the mail, actual paper. Who is this from? I don't know. It's from the Records Division. And Records Division, some random P.O. box in some small town in Georgia. That's nice. On the front is a little window with my postal address, and it says second notice, time sensitive. It's not actually a second notice of anything, so that's nice. There's a return envelope, and I think I'm going to put some papers in there and some scraps and just mail it back to them so that they have to pay for it, just because I'm a dick like that. Inside is a piece of paper. It's like a fourth of a piece of paper, about the size of a check that might come on a letter. And in the top left, a form is T2, and on the top right it says 2022, and it's in the font that looks like official government tax forms. And God damn it, I hate this shit because the whole intent is a trick. I mean, it's the 2022 benefit information for Illinois citizens only. Ooh, for Illinois citizens only. And I'm going to read what they have here. As a resident of Illinois, you are entitled to more benefits not provided by government funds. What? I don't know what they're talking about. You now have access to a 2022 state-regulated program which will pay 100% of final expenses up to $35,000. And I'm assuming final expenses, they mean funeral costs. So return this postage paid within 5 days to request this new benefit information. So it has something to do with funeral final expenses, death costs. Is probably some kind of death benefit insurance. Maybe they know something I don't know. Do I need death insurance? No, you don't need death insurance. Oh, by the way, if you are worried for whatever reason, and a lot of people get worried about this, people worry about dying and having no money and being a burden to their descendants, to their spouse, to their kids. If you have no money, well, you have no money, you can't really change it. But instead of buying insurance, you can actually get involved in a program where you prepay your burial costs. This works particularly well if you have no expectation of moving, you have a nearby funeral home. You can go pick out your own shit. If you don't want to be a burden, don't make me walk past the $25,000 casket to buy you a $2,000 casket. You can order all that stuff, have a contract, show it to your loved ones and say, hey, when I croak, go to this place. I already paid for this shit. And that'll be that. So this is one of these things. And of course, there's space here for me to give them my name, my age, my street address, my phone number. I mean, it looks like they have most of this shit because they sent me this document. But you know what? That's one of those random things I get in the mail here. Throw that away. I guess I changed my mind. I'm not going to actually mail them a bunch of shit. Also from an email. This one is a little bit more specific to me for the Phil Ferguson Show. So I've got this email. I am Ronald, SVP. I'm assuming it's Senior Vice President. It's not in his footer. So SVP of Strategy for a publicly traded financial technology company called blank. I am not going to give them the time of day, I guess, or I'm not going to promote their name. But it's funny that they say we're a publicly traded financial technology company. Well, that's a lot of buzzwords that you're publicly traded. Is that supposed to mean that you're more legitimate? Just for laughs, I went and looked up their stock ticking symbol, whatever. They currently trade at 45 cents a share. Yeah. Net income, is that a negative? Negative $350,000. Wow, that sucks pretty fucking hard. Really small company, hardly worth anything. This guy's the senior VP. How big is this company? He might be the only employee, for all I know, 2 or 3 of them. And then it gets personal, which is kind of nice, a nice touch here. I just listened to show 320, Bitcoin and other topics. I'm kind of editing this for your benefit. I enjoyed your insights. I appreciate that you share your skepticism on Bitcoin. I understand that crypto has a lot of intricacies, so your doubts are most welcomed. What? A lot of intricacies. So I'm taking this kind of as a slap, honestly. It's complicated, so I understand why you question it. Get the fuck over yourself. In case you're interested, I think what you discussed is especially relevant to our company's offering. I continue to read here. Our company offers 10% stable interest on cash deposits with a Visa, MasterCard, debit card to spend against it. So not quite sure what that means, but it sounds like they're going to give you 10% interest as long as you set aside some money via your Visa or MasterCard. So you rack up some debt, give them $10,000 on your Visa and MasterCard, and they'll pay you back 10% a year, assuming they stay in business. Interesting. I continue. Better than a bank savings account, right? We accomplish these interest rates, the 10%, by taking the funds, and automating the process of plugging them into global decentralized money markets on the blockchain. What a load of crap. We enable people to have these capacities without any technical expertise via a simple ACH bank wire. Works with Facebook and Gmail login. So you've got to give them your credit card, Facebook login, Gmail login. If you make a profit, they're going to have to report it. So, of course, they're going to ask for your social security number. Wow, this sounds like a great way to get all of your information. There's another paragraph. I'd love to talk about a sponsorship where you receive 10% of the revenue generated through users who sign up through your referral link. So for $100,000 in revenue generated, that'd be $10,000. While we do not do upfront payments, we feel this is a very strong value proposition. Considering your subject area, we feel you can monetize well from this. Happy to schedule a call sometime. You can reach me here on this calendar app of some kind. Regards, Ronald. So I don't expect that I'm going to contact them. I'm half tempted just to see what he says, but the sad state of affairs at this current time, I'm fucking busy. So I got other shit to do, but they're not going to give you 10%. And if they are, it has to come from new people coming online, and this is some kind of legitimized money pyramid. And this is the stuff that is with cryptocurrency and blockchain. It's just a new way to scam people. It sounds high tech. It sounds futuristic. It sounds sexy. Oh, you don't understand. Well, you know what? If you don't understand it, don't fucking invest in it. Keep it simple. I sometimes will refer to the advice that I give as really boring investment advice. It's about stocks and bonds, things that I understand, things that you can understand by reading a book or two. You're not going to understand this. I don't understand it. I'm not going to make even an effort to try to understand it because I'm pretty sure it's a scam one way or another that I'm going to end up losing money while they promise me 10% interest, which is not fucking possible. It's just not the way the world works. So I don't know. Maybe you want to contact these guys and go on an adventure and give them all your information and report back to me, but I'm not going to be doing it. I thought you might enjoy these couple of inbound scam things that I've seen.
Pace e lunga vita. Lunga vita e prosperità.
You're listening to The Phil Ferguson Show.
This is a little bonus investing skeptically segment about the value of diversification. A couple of weeks ago, I had said something that I've said before, and I tell this to clients, and I actually do say it the way I'm going to tell you here. When a client says, hey, Phil, what are you going to do to protect me from the market going down? And my mostly serious and frank answer is I'm not going to do a fucking thing. That's not what I do. I'm not responding to the day in, day out machinations of the markets. However, I'm not blind to what the market does, and I don't do any market timing, but maybe this is a semantic stance. I do market-based in adjustments depending on how things have gone over the last few years, what they might do over the next few years, what's the economy look like, what's inflation look like, maybe a teeny bit there. And more importantly, how close are you to retirement? And I've also said that my goal is not necessarily to beat the market, at least measured by the S&P 500, but over time, probably, hopefully, optimistically, perform as well as, or maybe beat the market, but with less volatility. And sometimes that less volatility comes at the expense of upside potential. So if you're close to retirement and you have 20, 30, 40% of your money in bonds and the U.S. stock market goes up 28%, you will not make 28% because you're not 100% in the U.S. market. And that can cause a little cognitive dissonance or dissatisfaction with people sometimes, but I'm not trying to beat any specific number in a week, a day, a month, a year, whatever. I'm looking at 5, 10, 15 years of performance and using, known history, known probabilities, of what things tend to do and tend not to do with rebalancing, asset allocation, all these kinds of things. But sometimes in the short term, there are pretty dramatic effects. And we're now at one of these places where we have a pretty dramatic effect. And I'm doing this in late February of 2022 because this is one of those analyses that are very, very time specific. It won't matter to you 6 months from now. Probably won't matter to you 6 months from now. It might. But I just want to go over the idea of what this diversification can do for you. And so the email I got from one of the listeners was basically, hey, Phil, when you say you're not doing a fucking thing to protect somebody from a market correction, you mean you're not doing anything additional because the diversification and the different asset classes, you've already kind of pre-protected people. And I thought, oh my God, yes. So what am I going to do to protect you from a market drop? I'm not going to do a fucking new thing. I'm going to stick with what I've already done, what I've already put in place for you. And so I worked up some numbers just for laughs to see, kind of a test, how has this worked? Because as of this recording, and it can be very different if you're listening to this days or weeks later, and it may not even matter, but I'm looking at what I have today. And I'm looking at numbers year to date to February 24th, not including the 24th, because I pulled the numbers from yesterday at the end of market close. Right now, year to date, the total U.S. stock market is down 12%. Some things are down a lot more. For example, large cap growth that holds all the names that you know is getting crushed, down 18%. Some of the really big stocks have been hurt really bad with the change in trends. I'm not going to go over the specifics, but you can look them up yourself. But the whole idea is that, okay, the total stock market is down 12%. What would have happened to you if you had a portfolio mixed like my current recommendations? And at first, I'm going to look at someone who is only stocks. So you're 15 or more years from retirement. If you had the mix where I have a little bit less in large cap than maybe one would have historically, less in growth, more in value, a smidge 5 to 6 to 7% in the REIT fund, and then 25 to 30%. I use 30% in this allocation in international because I've been saying I'm okay with 30% or maybe even a little bit more. The result is that instead of losing 12%, you're down 9%. Now, okay, it's only 3 points, but it's 3 points in under 2 fucking months. So this is the dramatic reduction of volatility. When markets go down, if you're spread out and you have put more things into things that have not done well, when the market changes directions, you can be protected. You might lose when things are continuing to go the same old way that they have. So the idea of momentum investing, things that have gone up will go up. Things that have been going up will keep going up. That's true very often for periods of time until it's not. And this is one of those periods of time where it's not true. And so by occasionally skimming a few percent off the things that have done the best and just simply rebalancing back into your own model portfolio, you need to create a plan for what you're doing. Once a year adjustment is probably good enough for most people. If you're well over $1 million or $2 million, maybe twice a year, once a quarter, but no more than that, please, because you're just spending time and effort to get no gain, at least based on what I've seen from historical research and mathematical models of how it's worked in the past. For people that adjust more frequently, there's no added benefit. There might even be a negative benefit. Now, if you're in full retirement and you're still following the Polaris plan and you have a generous portion of your money in the cushion, and I did this about 40% in the cushion. Historical modeling, the general rule in the investment world is 60-40, 60% stock, 40% bonds. When I have a client, I don't do it that way. I calculate how long the cushion will last based on the amount of money you need to take out, based on the recommendations of the maximum amount you should take out. And just to be clear, in this situation, the cushion lasts about 13 years for this theoretical portfolio, give or take. And of course, that's estimated guessing, so you never know exactly what's going to happen. It works out that it's about 40% of the portfolio, but that wasn't the driving calculation of how I got there. If you had a portfolio like this that had the U.S., real estate, international, different domestic index funds, all allocated in the current percentages that I think I want to be in, the result was not a loss of 12%, not a loss of 9%, but a loss of about 6.6%. So it's taken a lot of the sting off of the loss in case you are in the position that you are currently pulling out money. And some of the fun things that have really been amazing is, as an example, I mentioned the Vanguard Large Cap Growth Fund is down 18, but the Large Cap Value Fund is down 4. The Mid Cap Growth Fund is down 19. The Mid Cap Value Fund is down 6. So if you needed to sell some stocks, even at this time where the market is down 10, 12, 15%, you have a few places in the U.S. domestic stock market where you could skim off a few $1,000s and not feel quite as much pain. You could also even go into international because the International Value Fund is down 2, and emerging markets, kind of as a surprise, which has not done really well for many years, is down only 2% also. So even there, you have places where those investments are up over the last 12 months, over the last year, and definitely way up over the last 3, 5, and 10 years, where you could still skim off some of the things that haven't done as poorly. Well, if all of your investments, if all of your stock investments are in a handful of growth funds that all own Tesla and Microsoft and Netflix and PayPal and all these companies that have been just crushed down 20, 25, 30, 40% or more in 2 months, you could be holding a handful of aggressive growth or growth funds or whatever they call themselves, because those names are just marketing gimmicks, where your stock portfolio is down 15, 20, 25, 30%. And you say, oh, well, I still want to get some money out of my stocks. You can't pick and choose. You don't have the granularity. You don't have the ability to see what's inside of those funds. You don't have the clarity. So, just a quick thought. In summary, if you're in the total stock market as one fund, you're down 12%. If you have been following my model based on my calculation, which could be completely bogus, and you're relying on me accurately reporting the numbers that I think I've done or recommended, you'd be down only 9. If you're in or close to retirement and you're fully hedged and your cushion is fully loaded, you might be down about 6.6, which is still a buzzkill, but it's way better than being down 12 or 15 or 20%. So just some thoughts on diversification and why I recommend different asset classes, different segments in different markets, because you can still pick and choose and do pretty well even when a big portion of the market is down a lot. Thank you for still being here and listening to the show. I greatly appreciate it. A quick reminder again, the Patreon page, patreon.com/Phil. I am no longer collecting money from there. I am no longer going to post any content from there. I have been telling people for months to turn off your contributions to me. Thank you. Thank you very much for all of the wonderful people that were doing that. It's just something that I think is an unnecessary complication for me and the industry that I'm in as a registered investment advisor, as Polaris at least is a registered investment advisor. I don't need the extra complications that might arise if someone thinks there's a possible conflict of interest. It's probably a huge stretch and I'm being overly cautious, but that's okay. I don't want there to ever be a situation where someone donates or contributes to my podcast and then sends me an email and asks a question, and I answer that question, and somewhere someone in the SEC determines that I am now giving investment advice for a fee, which is the critical combination for investment advisors where you might have to have a client under contract. So the easy way to solve that is to not collect any money from any other sources other than clients. So I've shut that off. I've also turned off the ads on the podcast. You're welcome. They didn't really, they've been bringing a fraction of what they promised me, the fuckers. But anyway, I now have no ads. If you hear ads, hopefully that's only because they're old shows, and I'll be working on turning that off if I can. So if you hear ads on old podcast episodes, let me know and I'll call them or email them and try to get those taken off because they're added in real time or when you download the episode. So there's that. Other things. Sometimes at the end of the show, I play a song called Not Dead Yet. And that was written by my good friend Ralph Culvert. And he was the lead singer and writer. And actually, they still perform from time to time a group called The Bad Examples. He also has done his own independent work, and he's a friend of the show. And maybe a couple of years ago, he was on, and we had a great time talking stories about his experiences over the years. Interestingly, the song, I think it was Not Dead Yet. I think that was the song that was covered by Styx, another Chicago area band that you may have heard of. Styx did a cover version of Not Dead Yet. And that and any other songs that I use from the Bad Examples and or Ralph are expressly used with permission from him, that I can use them as end music at any time, with the hope that maybe a few people go buy some of his music and or contribute to his, his art. That's what we're going to call it, his art, his music. I find it to be beautifully well written and, just one of those people that when he does a song, the way he sets up lyrics to me paints a picture and I can see the scene far better than most music that I might listen to. So I very much enjoy that, and I'm happy to promote his stuff. And maybe I need to do a better job of giving credit. Again, Ralph Culvert and The Bad Examples. You can Google that and find the stuff. The song that I play the most is Not Dead Yet, although I've played a couple other tracks from his library, I guess. The other thing that I have failed to give credit for recently, and I've gotten a few emails, and I'm delighted that you have the interest, I have played samples of a CD, and again, I have done this with permission. This is a CD that was created by the Center for Inquiry. It still appears to be available on their store, but I do know it's in limited quantity. I really wish it was downloadable as an MP3 and on Amazon and other sources, but I have no knowledge that that has happened. CFI, if you're listening, I recommend that you do that because you could get a lot of downloads, and it's not about making the money on it. It's about the ability to share it with other people and to make maybe YouTube videos and people can share it and post it. It's really powerful stuff. The CD is entitled Robert Greene Ingersoll, and it contains pieces from About the Holy Bible and Why Am I Agnostic? And these were things from Robert Greene Ingersoll. He lived from 1833 to 1899. And the things that he talks about that are in the Bible and how to look at Christianity, sometimes it's a startling idea to think that, 120, 130 years ago, he had this all figured out. He was known as the Great Orator, and the audio recordings on the CD are not Robert Greene Ingersoll, but a paid performer, a Shakespearean actor. And I don't have the name of the Shakespearean actor because I'd be happy to mention them too, but he was paid to read these words that Robert Greene Ingersoll wrote and or spoke and then were written down later about the Bible and religion and Christianity. And I've been pulling segments from that double CD and using them as entertaining break material. And I have used them in this episode, so you'll know what it sounds like. Again, you can go to the Center of Inquiry store, or if you search Center for Inquiry, CFI, Robert Greene Ingersoll, 2 CD set, you should be able to get to it. Oh, it does say here, I'm looking at the store website now, downloadable files available after purchase. That may be new. I didn't know that. I can't access it because I bought the CD, many years ago. I don't know when it first came out. And when I asked them for permission to use the CD, they found out that they still had some more in a box. So they've added it back to the store. So I'm very happy that is out there. Go check that out. But the last few episodes, I've used some of that content. And again, thank you for the permission from the Center for Inquiry of using audio sound clips from the Robert Greene Ingersoll 2 CD set that they have created and is currently available while supplies last in their online store. So that's enough for now. I'm going to wrap things up and get back to work. And hopefully you found something useful in the episode. You can go leave a 5-star review at Apple Podcast or Stitcher. If you like the show, you can also recommend the show to friends and relatives and neighbors. Maybe they can learn something about investing, or they can maybe learn how much of a scam religion is. So hopefully last minute reminder pops in my head. Middle of April, the American Atheist Convention. I do plan on being there. I've bought tickets and everything. So unless there's some huge resurgence of COVID, I will be there, and I hope to see you. And until I get to see you in person, ciao.
Well, I was born too late to play in the Rolling Stones. I don't know Jimmy Page, I never met Yoko Ono. Standing with a strap, I'm rock and roll's bastard son. Go out, get drunk, get laid, have fun. Don't got $1 million, don't drive a Cadillac. Give me half a chance, cause I'm not dead yet. Not dead yet. Not dead yet. I'm a mad dog fighting with the wall against my back. You better get a bigger gun, I'm not dead yet. I've been machine gun, handgun, hijack, left for dead. Dive bomb, napalm, nuclear warheaded. Dropped from a jet plane with no parachute. Shot by a firing squad and raped by a business suit. Dancing on a landmine, one leg left. I can still crawl and I'm not dead yet. Not dead yet. Not dead yet. I'm a mad dog fighting with the wall against my back. You better get a bigger gun, I'm not dead yet. Well, you're bigger, rougher, meaner, tougher, dirtier and uglier and sneakier and trickier. You wanna shoot me with a gun, cut me with a knife. Take your bare hands and rip out my eyes. Kick me in the balls and you bit me in the neck. Well, hit me again, cause I'm not dead yet. Not dead yet. Not dead yet. I'm a mad dog fighting with the wall against my back. You better get a bigger gun, I'm not dead yet. Well, there's a mugger in the alley, there's a sniper in the hall. There's a girl at the bar wants to get me back.